right. Well, welcome. Appreciate you taking time out of your busy days to join us for our November webinar. This one is going to be on year-end planning. Hopefully, we're going to give you some ideas for creating some tax savings going into the holidays. We're hoping to have at least 5 minutes at the end for questions. So either chat in any questions as you're thinking of them, or write them down and save them for the end. So with that, I'm going to share my screen and start in on our presentation. So today we're going to cover year-end planning again and look at some top moves. Some of these are ones that we've presented in the past, and some of these are new ones as well. But with that, a little idea of what our agenda today is going to be. We're going to start out with kind of the basics. We're going to talk about personal income, taxable income, and look at marginal and effective tax rates, how to calculate those, as well as what the difference is between the two of those. And then we're going to look at health insurance, health savings account, different retirement plan options. We're going to look at little tax idea for everyone with the short-term rental. Sometimes people refer to it as the Augusta Rule. And then I've got a list of some other ones that mostly apply to businesses. And so hopefully we'll give you some great ideas going into the holidays to minimize your tax, generate some tax savings that you can put to good work. So with that, little legal disclaimer, we're preparing this content for your use. We just ask that if you're going to share it with anyone, that you let us know, and we're happy to send you the slides. Recording is going to be up on our website afterwards, so that you can feel free to share that with others. So let's start out with understanding personal income and tax rates, specifically marginal versus effective. So what you're looking at is this is kind of your standard page 1, 1040. Your wages, your K1 income, your IRA distributions, all that goes into your total income. And then there are adjustments, and then your adjusted gross income. And then there are further adjustments. One of the big ones with S corporations is the qualified business income deduction. And that one is spectacular. It's been around for a while. And essentially what that is a deduction that's calculated based on your profit. So essentially 20% deduction for just having a profit. And then looking at tax rates, the more you make, the more you pay. One thing to keep in mind is, just for a simple example, we've got a taxpayer, 100,000 of income. That puts them in the marginal tax bracket of 22%. So the marginal tax rate is 22%. However, they did have some income where they were paying at 10% and 12%. So when you calculate what their actual federal tax is and compare that to their taxable income, their effective tax rate is 13.2%. And that's just something to keep in mind. It's good to know when you're thinking about whether you're paying too much or too little. Okay, so first tax move is health insurance. Unfortunately, health insurance has become one of the largest expenses for most businesses. The rates have gone up substantially, and there's two different flavors essentially that we see in businesses. One is a group plan where there's more than one included in the group. And in that case, the business is paying the premiums. If there aren't the resources to offer health insurance to employees, then the owner would have an individual plan in most cases. Now, what's important is, especially in the case of an S corporation, in order to get a deduction for the substantial premiums that you're paying for your health insurance, you need to have, number one, the corporation reimburse you for those individual premiums. And then that needs to get added to your W-2. So it's actually a compensation deduction that is getting offset with an adjustment on your 1040. But something to keep in mind, if you don't do it the right way, you could lose a valuable deduction. Next, the health savings account. These have been out for a long time. And number one, if you don't have one, look into adding one to your mix. And what this means is if you have a high deductible plan and your insurance plan allows for health savings accounts, you can essentially get a deduction for contributing to, it's very similar to like a health individual retirement account. So you're building a nest egg that you and your family can use for your medical expenses. And essentially what it's doing is it's giving you tax-free out-of-pocket medical expense, and can be very valuable in reducing the high cost of your medical expenses. And they're substantial. In an individual plan, it's a $4,300 max. And then on the family, it's $8,300 with a bump up if you're over 55. Little logistics. If you don't have one, this is what it looks like. Essentially, you would contact your insurance plan, make sure that it's eligible for an HSA account, and then ask for a recommendation, from your broker or your insurance provider, and then set up the account. Works like a checkbook, in that you're just paying for your medical expenses with checks that you send, just like bill pay on your regular bank account. You'll also get most likely a credit card, which operates like a debit card, and you can present that to your medical providers. It's very convenient. And again, you're getting to use pre-tax dollars for your medical expenses. The third, and this is a big one, are funding retirement. So this is one of the best things that a small business owner or an individual can do, is to set up a retirement account early and start funding. Some of the factors that go into determining whether one plan is better for you or not is looking at what your funding goals are. How much money do you actually have to put into retirement plan expenses? What your number of employees are, whether you need a Roth, and then if there's any vesting that you want to deploy. And so put together this chart and get it on the screen. Okay. So this lays out many of the options. So probably the one everyone's most familiar with is 401k. And we see those in growing businesses with employees. There's also a safe harbor 401k for businesses that want a more simpler approach, that has matching involved. Sometimes, that can be popular with employees so that they know what they're going to have contributed to their plan. Simple IRA, this is generally for small businesses with under 100 employees. SEP IRA, for self-employed small businesses. This was something that was more popular prior to these simple IRAs and solo Ks. Solo K is just like it says, with a self-employed individual with no employees, and then the defined benefit plan for high earners near retirement. Because, I mean, if you look at going back to what your funding goals are, this defined benefit plan, you can sock away up to 300,000 plus. So if you didn't get an early start on funding your retirement, you've got a successful business. It works well, especially if you're one of the older ones, because that allows you to essentially catch up your retirement quicker. And so that is one of the main considerations. How much are you actually going to contribute? Because there is an expense that goes along with setting up these plans. It requires time and effort, and then also cost. The good thing about costs are they can lead to a credit. So I guess in one sense, it's never been a better time to set up a 401k from the standpoint that you can get a credit on your tax return for the fees that you're paying out of pocket. So you're paying a little more for a 401k versus a simple, but you're able to contribute more to a 401k. So if you have the opportunity to fund more, it's probably worth it. Also, you've got a Roth option available versus a simple where you don't. And then you're paying for a third-party administrator or a plan architect, but that plan architect is going to do your testing and make sure that your plan's in compliance. The last thing that you want is to set up a plan that's out of compliance and then it gets disqualified and you lose your deductibility of those retirement plan contributions. So there's a lot to consider. One of the things that we do at Kenny & Kenny is help our clients pick the right plan. And if you're interested, we'd be delighted to share this chart with you after the session. Just email. I'll share the info at Kenny CPA afterwards, and feel free to email that, and we'll make it available to you. But many options, many opportunities to minimize your tax with retirement plans. Just to give you an example, if we've got an employee with 40,000 of wages, there's basically two different types of flavors. There's an employer contribution, which in our example, we're looking at a simple IRA. Generally, those employer contributions are somewhere around 3% of wages. So in this case, it'd be a $1,200 contribution to that employee, and also an expense or deduction on that company's tax return. If it was a SEP, the max would be 25% of wages. In this case, 10,000. Then there's another component where the employee can defer out of their wages into a 401k type vehicle. Under the simple IRA, you can contribute if you're over 50 up to 20%. So or 20,000. So you'd be able to defer up to 20,000 in wages into your simple IRA, and that would leave taxable wages of 20,000. In the case of a full-blown 401k, you could contribute up to 31,000 if you're over 50. So again, going back to one of the main factors being, how much do you want to fund? How much could you fund? So if you can fund, if sky's the limit, then maybe you would spend the money and set up a 401k. And put in the 31,000, leaving 9,000 of taxable wages. So the fourth idea is short-term rental of your residence. So this is something, most of us have residences, and in the whole scheme of Airbnb, some people, this is off the table, but some say, well, why not make a few extra bucks? Well, as long as that rental is under 15 days, it's essentially tax-free income to you. So just an idea, this is called the Augusta Rule. Homes around the tournament, they were fetching big time money, and this got put into effect, and some clients have taken advantage of it. So wanted to share that with you. Finally, we're looking at some other great moves that we've seen time and time again, and have clients help them execute on these. But the first one, this is something that many businesses will do. They'll accelerate deductions. Essentially, if you anticipate that you're going to have an expense coming up, say in January, you may want to, if you're having a great year in 2025, accelerate it, make the purchase in 2025 so that you receive that service or that supply in 25, so you can include that in your deductions. Also, taking advantage of Section 179 and bonus depreciation, which was extended. And bonus depreciation basically creates fixed asset purchase which has a life of over a year, and turns that into an expense or a deduction, which can be very valuable. In other words, if you anticipate that you're going to need some new computers in 2026, and again, you've had a really strong 2025, why not accelerate that purchase, make it happen in 25? It's important to know that you need to receive those computers and put them in service in 25, but then you'll get to get that expense or that deduction in 2025. Moving on, this is a big one. Your entity structure drives how your business is taxed. So this is something that you always want to consider coming up to the end of the year. Maybe the year turned out better than you thought, and you're set up as a sole proprietorship, where you're paying self-employment tax on every dollar of profit. You ended up hitting it out of the park, so you say, well, maybe I want to make a late S selection and look to minimize my self-employment tax. If you're looking for something like that, that's something that we can help. We a lot of times help our clients do. Or maybe you're heading toward a great year in 2026, where you would elect to be taxed as an S corporation. That's pretty common. That's something that you want to consider, because again, the entity structure is going to drive how that business is taxed. Related to that is doing some compensation planning. I mentioned a very valuable qualified business income deduction. That's something that you want to maximize. Essentially, you're getting a deduction based on your profit without having to spend money to get that deduction. And then finally, charitable contributions. this is something that's relevant for 2025. If you're going to be itemizing, you may want to accelerate some of your 2026 contributions into 2025, especially if you anticipate making the standard deduction in or using the standard deduction in 2026, and get the full benefit of that. Now, in 26, under the new tax bill that passed in July, there is something for non-itemizers, in that even if you take the standard deduction as an individual, you can deduct up to $1,000 of your charitable contributions, and then married filing joint up to $2,000. So that's a nice improvement for the standard deduction folks. So we've got plenty of time for questions and answers. And again, if you want a copy of the slides, if you want a copy of the retirement plan chart, just email us info@kennycpa.com. This webinar is going to be up on our website, available to share or download or listen to again. But let's dig into some questions that are out there. Yeah, go for it, Alex. Good to see you.
Yeah, good to see you. It's been a while. I got a question about setting up the 401k plans. Some of the TPAs that I've worked with, they're hesitant to get something started. Are you able to get something set up and in place before the end of calendar year 2025 to make that happen, or is that a 2026 issue for you guys? And I'll mute my line.
Well, we're not TPAs, but you could, the ones that we work with and have worked with, I think they could get a plan in place before the end of the year. And I'm glad you brought that question up, because you can even set up a plan after the end of the year. You just lose the eligibility for the 401k piece. So you could, theoretically, if you kind of miss the window, you could get something going for 26. But now is actually kind of it's a good time to get going on a 25 plan. I think there's plenty of time to execute on one of those. I mean, as you know, there's a fair amount of education to the owner as well as the team in making the most of those plans. But I think, if we can help a client avoid waiting a year to get going on their retirement account, we'll try to move mountains if we have to.
Got it. Thank you, Tim.
You bet. All right. Well, hey, thanks for taking time out. Hopefully you have a little time left over for lunch, and we'll see you next month. Thanks again, everyone.